Welcome to National News Report, where we break down what the headlines say and what they don't. Before we begin, if you care about clear, fact-based analysis of U.S. politics, economics, and global power, subscribe to the channel now. We publish fast, focused reports, so you don't have to sort through noise to understand what's really happening. Now here's the question everyone keeps asking, but no one seems able to answer honestly. If America's economy is doing so well, why do millions of Americans feel poorer than ever? By the numbers, the United States looks strong. GDP growth remains positive. Corporate profits are high. The stock market continues to hover near record levels. Unemployment, at least on paper, remains relatively low. And yet, ask working families across the country how they're doing, and you hear a very different story. Rent feels impossible. Grocery bills keep climbing. Healthcare costs are exhausting savings. And for many households, every month feels tighter than the last. This disconnect between economic statistics and lived reality is not an illusion. It is one of the most important economic stories unfolding in America right now, and it's reshaping politics, markets, and public trust in ways that will define the country's future. Today, we're going to explain why the American economy can appear strong on the surface, while so many people feel financially trapped underneath. We'll break down what the data actually measures, what it ignores, and why the gap between growth and real life keeps widening. This isn't about partisan talking points. It's about understanding how modern economies distribute pain and reward, and why traditional indicators no longer tell the full story. To understand what's happening, we have to start with how economic success is measured. GDP, or Gross Domestic Product, tracks total economic output. It tells us how much the country produces and sells. But GDP does not tell us who benefits from that production. It does not measure affordability, financial security, or stress. It does not capture whether growth improves daily life for the median household or concentrates wealth at the top. Over the last decade, a growing share of economic gains has flowed toward asset owners rather than wage earners. When stock prices rise, investors benefit. When housing prices climb, existing homeowners see paper gains. But for renters, first-time buyers, and workers whose wages lag behind costs, those same positive indicators feel like punishment, not progress. This is why Americans can hear that inflation is cooling while still feeling squeezed every time they swipe a card. Inflation slowing does not mean prices are falling. It means they are rising more slowly, from levels that are already painfully high. A grocery bill that jumped 25% over 2 years doesn't become affordable again just because it now rises by 3% instead of 8%. Wages, meanwhile, have increased unevenly. High-skilled and specialized sectors have seen strong gains, while large parts of the service economy remain stuck in slow growth. For many workers, pay raises have not kept pace with rent, insurance, transportation, and childcare. The result is a widespread sense that no matter how hard people work, they're running in place. Another factor rarely discussed in headline economic coverage is debt. American households are carrying record levels of credit card balances, auto loans, and student debt. Even as incomes rise modestly, interest costs absorb more of each paycheck. When borrowing becomes more expensive, financial pressure builds quietly until it suddenly becomes visible through defaults, delinquencies, and stress. At the same time, economic growth itself has become more concentrated. A small number of large corporations and sectors now account for a disproportionate share of profits and market gains. That concentration creates efficiency on paper, but fragility in real life. When growth depends on fewer pillars, the benefits spread less widely, and the risks become harder to manage. This is why the economy can look healthy in aggregate, while trust erodes at the individual level. People don't experience GDP. They experience bills. They experience job insecurity. They experience the feeling that one emergency could unravel years of effort. And this perception gap matters, because when people stop trusting official economic narratives, they stop believing institutions understand their lives. That loss of trust doesn't stay economic. It becomes political. It shapes elections, policy demands, and social stability. Now we'll look at how inflation psychology, housing shortages, and policy choices have combined to deepen this divide, and why simply pointing to strong numbers is no longer enough to restore confidence. Now let's bring all of this together, because the gap between a strong economy and a struggling public doesn't close on its own. In fact, if left unaddressed, it widens. One of the most underestimated forces driving this divide is inflation psychology. Even when inflation slows, people don't mentally reset prices to what they used to be. They remember what life felt like before essentials became expensive. So when officials say inflation is under control, but households still pay more for rent, food, insurance, and utilities, trust breaks down. The data may say stabilization. Lived experience says loss. Housing is the clearest example. For years, America underbuilt homes while demand kept rising. When interest rates surged, affordability collapsed almost overnight. Homeowners with low fixed-rate mortgages are insulated. Renters and first-time buyers are not. This creates a generational split where stability depends less on effort and more on timing. That is not how Americans believe opportunity should work, and the resentment is growing. Healthcare follows the same pattern. Even insured families face rising premiums, deductibles, and out-of-pocket costs. Medical debt remains one of the leading causes of financial distress, regardless of employment status. An economy that grows while people fear getting sick does not feel like a successful one. Then there's the structure of modern work. Productivity has risen. Corporate efficiency has improved, but job security has weakened. Gig work, contract labor, and algorithm-driven scheduling create flexibility for companies and instability for workers. Income volatility makes planning impossible. And when people can't plan, optimism disappears. Policy plays a role here too. Many economic tools are designed to stabilize markets, not households. When interest rates rise to control inflation, asset markets adjust quickly, but renters, borrowers, and small businesses absorb the shock. The benefits of stabilization are long-term. The pain is immediate. And when relief is delayed or uneven, frustration hardens. This is why simply repeating that the economy is strong no longer works. Strength without distribution feels hollow. Growth without security feels threatening. And progress without trust feels fake. What Americans are reacting to is not just price levels or wage growth. They are reacting to uncertainty. The sense that the system no longer protects effort, rewards patience, or guarantees stability. When that belief erodes, even good economic news sounds disconnected from reality. The real risk is not recession, it's disengagement. When people stop believing the economy works for them, they disengage from institutions, from civic processes, and from long-term thinking. That disengagement shapes politics, markets, and social cohesion in ways that are far harder to reverse than any downturn. America still has enormous economic potential, but restoring confidence requires more than numbers. It requires acknowledging what people are actually experiencing and designing policy that treats stability as a feature, not a byproduct. Because an economy that looks strong but feels weak is not sustainable, and the longer that gap persists, the louder the consequences will become. You've been watching National News Report, where we focus on facts, context, and the deeper forces shaping America and the world. If this analysis helped you understand what's really happening beneath the headlines, like the video, share your thoughts in the comments, and subscribe for fast, clear updates you can trust. We don't chase noise, we explain reality. Thanks for watching, and we'll see you in the next report.